Hey guys, it's Nick. The market sold off again after being up early in the day, and now Netflix is down about 20% after reporting their earnings after the market close. So all signs are pointing to the beginning of a big downturn in the stock market. If you have never lived through a bear market, I'm going to explain how sentiment changes about different classes of stocks. Buying the dip works until it doesn't. And if you don't change when the market sentiment changes, you can end up catching a falling knife and possibly wiping out years worth of your stock gains. In this video, I'm going to explain simply how this works so you know how to navigate a changing market to minimize the damage to your wealth. And for those that don't have time to watch the whole video, here is the executive summary. At the peak of a bubble, the most speculative assets have the biggest percentage jumps. This means penny stocks, companies with no earnings, cryptos, NFTs, and even lumps of coal that are relabeled as black diamonds from outer space. I kid you not. When the bubble pops, those speculative assets, along with those precious black diamonds from outer space, go back to being what they really are, just a lump of coal. So here's how it works. Here is the historical PE ratios for the S&P 500. Now, historically, the S&P 500 PE ratio is around 17, which means if a company made $1 a share in earnings per year, you would be willing to pay $17 for that share of stock that produces $1 in earnings a year. That's a 17 PE. So here during the internet bubble, the PE ratio was above 30. During the financial crisis around 2009, it was around 26. But after that crash, it fell below the average down to about 12 or 13. But you see, as it climbed out of that bear market, the PE ratio rose above 20. And so what that means is for that same $1 of earnings, people were willing to pay $20 a share instead of 12 or 13 down here at the bottom of the market. Now we are way above that. We are above 30 even on the PE ratio. So let's look at stocks like different kinds of food and the earnings that the stocks make as the nutrition that they give you. And so the PE ratio is how much money you spend for the nutrition that each food group gives you. And so this is the cheapest food, rice and beans, but gives you very good nutrition for very little money. And so stocks like this would be the Coca-Colas, the Walmarts, the Procter & Gamble's of the world, that kind of thing. They typically have a low PE and stay there, and they have consistent earnings, while the other kinds of food that people are more usually interested in if they could afford it are kind of the tech stocks, the Microsofts, the Intels, and at some point the FANGs, the Googles, the Apples, Facebook, and that kind of thing. They still give you good food, they give you good nutrition, right? But you're going to pay up for it. You're not going to pay 17 times earnings. You're going to pay more for that, even in a bear market, let's say. So in a bear market, when the staples are 12 or 13 PE, the Microsofts and Facebooks and Googles and Apples and Amazons might be 30, 35 or something like that. And then over here, you have the crazy assets that, you know, the gourmet food, the haute cuisine that is just a design on a plate but has really no nutrition. And during a bear market, nobody's willing to pay up for this stuff because they don't have the money. They're on rice and beans and maybe some meat once a week or something like that. So this is the NFTs, the cryptocurrencies, the penny stocks, the unicorn stocks that have no earnings but have a good story. They do nothing during a bear market. But as a bear market turns to a bull market, this is what happens. The Walmarts and the Procter & Gamble's and stuff, they go back up to the 17 PE. And as the bull market continues, for that same amount of nutrition that you were normally paying 17 for, they start going higher, 20, maybe 25 or something like that, right? At the same time, the stuff that most people really want, the steak, the meat, the chicken, the fish. These are the FANG stocks. They go from maybe a 30 PE up to a 50 PE or something like that at the top of a bull market. Now, the really speculative stuff at the peak of a bull market goes really crazy because these are the people that don't have a lot of money to invest, so they want big percentage gains for their little bit of money. That's why they venture into penny stocks, crappy cryptocurrencies that get pushed by influencers, NFTs, whatever get-rich-quick scheme that is pumped to them, they'll believe it and they'll pump it up to insane levels. And so I can't even put this on the PE scale because a lot of these stocks have no E, they have no earnings. So these are the kinds of stocks you see in Cathie Wood ARK ETF, where the majority of stocks are stocks that lose money every quarter, but they have a good story and they had a nice run up. But before the bear market happens, these things start to shrink back down slowly and then quickly before people really start to notice. And that's what's happening now. You see, in a healthy bull market, all of the stocks kind of move together as they make new highs. But cracks start to appear when only the leaders in an index, like the FANG stocks, continue to make new highs, but the majority of the rest of the stocks in the index start falling or not making new highs or making new lows. And so this chart shows that very well, that there's only 35% of NASDAQ companies that are above the 200-day moving average, with NASDAQ at an all-time high. So NASDAQ is making all-time highs. Here's the composite, but here are the percentage of stocks that are above the 200-day moving average. Back in March, it was like 90%. Now it's only like 35%. So these are all the Cathie Wood ARK stocks that were going up before but have no earnings, and now they are deflating. And so the last of the stocks that usually fall are the leaders, the Apples, the Facebooks, the Googles, the Amazons. They're the only things that are holding up these indexes at this point. And so before the bull market ends, anytime there's a dip, all the buyers come in and it goes higher. There's another dip, the buyers come in, it goes higher until it doesn't. And so at some point, there's going to be a dip. People are going to buy. Then there's going to be another dip. People are going to buy again until it hits the point where it dips so much that people lose faith. And instead of buying the dips, they're selling the rips. And so that is the sentiment change, that these things are no longer going to make new highs and you need to get out of them. And once these leaders like Netflix start falling hard, like you saw today with their earnings dropping 20%, people are going to be more worried about their regular tech stocks and their regular stocks, that they're going to throw these out first and get rid of them because they know they are the most speculative. So these fall percentage-wise the quickest. Then the tech stocks, which have earnings and all of that, but they just have high PE ratios, they start to shrink to the point where they overshoot the PE ratio on the way down. So they might go below, I don't know, 17, 20 or something like that. And then even the so-called safe stocks that are now at a 25 PE, the Coca-Colas and Procter & Gamble's and Walmart, they now, not only do they go back to the historical average, but in a real crash, they even fall below it for a period of time before they start creeping back up to the average. So guys, when the leaders are holding up the market and then the leaders even start to crack, you know that sentiment has changed. And so Netflix today reminds me a lot of Yahoo back during when the internet bubble first started to pop. So if I remember correctly, the market started going down and Yahoo was the bellwether for internet stocks, if you could believe it. And I remember they were going to report earnings after hours when the market was already down or something. The sentiment was already really negative. But Yahoo was still priced to perfection, like, I don't know, $100, $150 or something like that. And I remember thinking that even if they have good earnings, the stock is going to sell off. Even if they have kind of expected earnings, the stock is going to sell off a little, right? But if they have bad earnings, it's going to really tank. And I believe they were pretty bad earnings. And so it just gapped down a whole bunch. And that was kind of the beginning of everybody looking at all these internet darlings with a different kind of eye. And so they quickly started separating the ones with no earnings or no hopes of having earnings anytime soon and really sold the crap out of them. So guys, don't be the last one to believe that you can always just buy the dip and it will work just like it did in the past. When sentiment changes and people are losing money, not only in FANG stocks, but in Coca-Cola and Walmart, then they dump the most speculative stuff first. And that means those type of stocks that have no earnings, that's in the ARK ETF, penny stocks, cryptos, NFTs, and any other collectibles with a so-called good story. So when sentiment changes, it happens quick. And when people come to their senses about holding on to stocks with no earnings or just high PEs even, the market can readjust very abruptly and very violently. Don't get caught in the middle. If you like this video, hit the thumbs up and I'll see you in the next one. Thanks for watching, guys.